Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, March 27th, 2024. It's 1:55 p.m. Eastern Time, so we've got about another 2 hours to go. Figured I'd do an update. I've been quiet today. There's just not a lot I'm seeing, but there are a few things I do want to point out worth mentioning for sure, and hence the video. Mostly flat day. We're been trading mostly slightly red on the Nasdaq 100 all day today, slightly positive on the S&P 500. The big gainer on indexes is the small caps, and I want to get to that in a second. That's one reason I want to do the video. So here's that. This is that 15-minute chart of QQQ I've been sharing lately with the trading range. That was Thursday's pop into the trading range where we took an objective short entry was highlighted there with the divergences and a swing target down to the bottom of the range. Active traders, you have these levels I've laid out. Every line on there is a horizontal support level in which you could target. So this morning, we have to zoom in real tight to see it. We hit that 441.90 level. The low was 441.93, close enough for government work, and another reason why, if that's what you're targeting, you set your stops or your sell buy to cover limit order slightly above the actual support level that you're targeting, because quite often buyers will step in a little bit early. Other than that, it's been a steady drop since the post-FOMC pop. Remember, this was the FOMC ripped late, with just an hour plus to go on trading on Wednesday when they did the announcement. So the buying climax so far was on Thursday, and they've been steadily, not impulsively, but steadily fading in. I've talked about that earlier in the week. This early makings of a downtrend. A downtrend is simply any security making lower highs and lower lows, and today with the lower low, that's what we have. So that keeps that intact. And not much else to add to that, other than I did want to mention, I highlighted this level the other day, 0.10, the delineation between for the near term. Remember, this is a 15-minute chart. If you're a long-term swing trader investor, this really has very little, if any, bearing on that. This is more active trading, but that we have crossed down the PPO signal line, which is the last of the two to cross. That is now crossed, and we're below, back testing from below. And when that happens, quite often, like right there, it often it's not the zero line, because again, I use it different on every security. I have my line just below the zero line, but that helps to delineate bull and bear trends when you're above and below it. So it's just something worth mentioning. And if you cross back above, you still have a downtrend line off the highs right there. And again, ideally, you'd want to see things remain below there. If you take out the downtrend line, you still have previous reaction highs there, and there, and of course that one as well. So I don't want to read too much into a day that's flat. I just wanted to point those things out. Oh, and I'll also mention that what I'm seeing, I'm going to get to Treasury bonds and interest rates in a second, along with small caps, which are the most rate sensitive of all sectors, and point out that what I'm seeing today, and I am seeing IWM trying to peek its head back into, IEF, the 10-year Treasury bond ETF, it's trying to peek its head back up into that green zone. We're going to get to that one second. But I'm a little suspect of it only because we have the bulk of the Mag 7 stock, or what I call formerly known as Mag 7. There's really Mag 5 right now. Nobody's going to argue Tesla is no longer magnificent anything. Peaked years ago, and it's way off its highs. So that's a former Mag 7 component. And Apple, I think most will agree too. Those are the ones that are rallying today. The only Mag 7 stocks that are rallying are the ones that are beat down the most. Looks like bottom fishing from retail investors. I hate to read too much into one day, because I always say one day doesn't make a trend, but that's what's up today is Apple, and it's still at very key support. And then Tesla, of course, beat down as well. And the most constructive, if you want to, play a hedge portfolio right now, if you were to be short the NASDAQ 100, or the markets as a whole, those are the ones you want to be long. They're already beat down, they're oversold. And with Tesla, you have a divergent low. Apple, you don't. I can't make a case to buy Apple other than it's down and crowd favorite. But on the contrary, I would not. Just want to be clear by it. Tesla, and again, that's what's rallying today. And then Amazon is the only other one. The rest are all red today. Microsoft, Nvidia, Alphabet, and Meta. All right, let me go over to the small caps. Let's talk about that real quick because that's what's showing up on my radar today. IWM up about 1.4%, and I think you can see my lines, but if not, I'll just draw them here. This is the divergence line right there. Big, clear negative divergence on the indicators. And the uptrend line right here, which was broken with an impulsive breakdown, and we recently back tested, and that 208.50, which I covered recently, is also the bottom of that very, very technically significant trading range from back there when the small caps peaked back in 2021. So just like Tesla, small caps are well off their highs back from a couple of years ago, as are the majority of all stocks in the universe, as I showed you in recent videos covering market breadth. Over 50% of stocks below both their 200 and 50-day moving averages, and so that's the story. Same story. So we're watching those big tech stocks until they break, until the majority of the leaders break. The market won't break. But let's talk about this. So other than this being a back test of the recently broken trend line and another rally into the 208.50-ish called 209 resistance, provide an objective short for small caps. Other than that, we have IEF. Now remember, small caps are the most rate sensitive. Let me go back to this real quick. Let me go back to IWM and show you another board. Don't ever take my word or anybody's word for anything, because there's a lot of stuff out there of people making incorrect claims on the internet. So I like to show you these things and talk about how from a fundamental perspective, small caps are more rate sensitive because they are highly dependent, and almost all of them are dependent on borrowing to keep their finances, their operations going, unlike Apple and all the big mega caps, the former the Mag 7 stocks, whatever you want to call them. They're cash rich, cash cows. They have more cash than they need. The only debt they have is because they could borrow. In recent years, since 2008, we had a zero interest rate policy. And it made borrowing costs almost nil. So a lot of companies like those, like Apple, for example, started issuing bonds only because they could with almost free money, and they use that money to buy back their stock. So remember, they don't have to borrow. So when rates go up, they can rely on cash flow and to continue operations. And whereas the small caps, and here's the thing. So really this hypersensitivity to rates began when we started having an inflation problem and rates making the biggest move up in almost half a century. And so as you can see here, we have IWM in white, IEF, which is a 7 to 10 year Treasury bond ETF, and you can see without really any exceptions, there's brief periods of disconnects, they move in lockstep. And so what you're seeing when you look at the 10-year bond, when the 10-year bond's falling, rates are going up, and small caps take it on the chin. And every time you see a rally in bonds, meaning rates pull back, small caps love it and they get happy and think, okay, worst is over. But no. So you can, again, you can see this correlation. It's very tight. And then what you look for are those periods. There are periods of disconnect between the correlation where the small cap stocks don't get the memo. So I'll give you an example here. Right there, here's where the 10-year bond peaked. Rates started going back up. Bonds were falling. Small caps were giddy. They didn't get the memo. They rallied, and then it's the real deal. So interest rates continue to go up with bonds falling, the orange line, and then small caps played a pretty violent game of catch up right there to the downside. And so I just wanted to point out that's what we're seeing here once again. So they were moving in lockstep until recently, both going up. Remember, these lines are not going to overlap. They're on different price scales. The 10-year bond doesn't move up and down in the same percentage terms day to day as stocks do. So you look at the inflection points, the peaks and the troughs, and you can see it was a very strong correlation until recently. So small cap said, All right, F this. We're going up. Everybody, all these brokerage houses, wirehouses are raising price targets, and Powell told us the economy is going to grow this year, but bonds are saying a different thing. So who's going to be right? Who's going to be wrong? Well, I just made the case right there for you early on, based on just pure technicals. You have small caps at resistance, recently coming off a big divergent high, overbought readings, and back testing a primary trend line. So that would be where my money is where my money is. And then, there's the possibility that small caps break out and maybe the bond market was wrong. And then you're going to see bonds rally as long-term rates fall. So that's the bull case. If you believe that to be true, just, set your stops accordingly and be long or go long. Otherwise, I just wanted to point out this divergence here as a sort of a red flag that's the peak right there in treasuries. That was a lower high, and you have lower lows. So this is a downtrend with treasuries peaking there and IWM making a new high over that same period of time. So that's that. And let's just loop back to QQQ for a second, just to look at the tech sector as a whole. I want to go to the weekly chart. I already showed you that short-term trend indicator on the PPO. Crossing down below that, again, not the zero line, but the negative 0.10 line just below. And here's that histogram we're still watching for, crossover on QQQ right there, which again appears imminent. And I say this often because it bears repeating. Imminent on a weekly time frame is measured in weeks to months, and depending on really what you're looking at, you can make a case for even years. Divergences tend to build over years, positive and bullish. Months to years, I should say. I'm sorry to stand corrected. Months to years. And that's that. Typically, the positive divergences, because corrections happen so fast, markets fall, those tend to form over just months. And it's the negative divergences that can form over a year or more, but sometimes it's just months. Anyway, so that's what we still have, and just watch that. It's one thing that to look out for. Okay, and remember the canary, I like to call the canary in the coal mine for the tech sector. All my lines got muddled on the weekly chart because this charting platform, love it as much as I do. That's the one gripe I have every time there's a split on an ETF or a stock. They don't adjust for the trend lines like a lot of charting platforms do. You got to go back there and sit there and replicate all these trend, drag them, put them back into place, or redo it. All right, so this is SOX, just the semiconductor, one of three semiconductor ETFs, the big ones, still has that divergent high, bearish engulfing candle. We're nowhere near taking it out. We're below the trend line as well, the uptrend line, and those were the targets I gave you after that. T1, 2, 3, still not there yet. And then you have the other semiconductor ETFs out there as well. XSD, that's Spiders, S&P 500, still more indicative of the semiconductor sector as a whole because it's much more diversified than SOXX. SOXX has an oversized weighting to NVIDIA and a couple others, but in that one too, also bearish engulfing candle, divergent high, and still well off its 2021 highs, but with that divergent high, nice divergence. And then the other one was SMH. And SMH, again, split, so you got lines everywhere. Just ignore that. There's that bearish engulfing. And then the big ones is, like I've said, the poster child for AI, the poster child or the leader now of the semiconductor sector by far without even a close second is NVIDIA. You have a $2.3 trillion market cap, and Taiwan Semi right behind it, but well behind it at $727 billion. So really it's less than a third of NVIDIA. And there's NVIDIA, so still put in that divergent high, bearish engulfing candle, followed by a trend line break, back test, and it's still below the bearish engulfing candle, and so no update there. Its partner in crime, or what I call its sidekick, is SMCI, and that one also bearish engulfing candle, bearish rising wedge breakdown right there, a little kickback rally, and starting to, we'll see, move down. Maybe you can go to a 60-minute chart and see if we can, haven't done this yet. I want to just see if that trend line fits. Close enough. We'll see. So there's your wedge breakdown. and basically it needs to take out these lows. Obviously, each and every reaction low helps, but this low right now is the one that should do the trick for that particular stock. The low from Wednesday the 20th, last week, or aka Fed Day. So there's, kind of like the stock market too, a little bit less of a fade so far. But remember, the stock market, when you go to SPY and turn off all the lines, you had the Fed day, and then climaxing with that really the first full trading day after we popped up, and it's been nothing but red sticks so far. Today it's green by a quarter point. If we close red today, it'll be just nothing but selling since, and again, that's the what I call post FOMC noise. So it takes usually until the end of the week, or most usually the following week, which is this week now, to see which way the market, the lasting direction the market's going to pick. Now, it's way too early. 3 down days doesn't make it. Again, you have to, if and when we fade the post FOMC rally, then you can say with a pretty high degree of confidence, this was the real whipsaw, and this is the direction the market wants to go. So we'll see. Probably be told. Well, remember, tomorrow's the end of the week. That's the thing now. We happen to have, just the way this FOMC meeting fell on, this week, the week after, is a truncated 4-day trading week. It was a Good Friday. We're closed on Friday, so tomorrow will be the last trading day. But so far, so good. Just nothing to get excited about, but I'll take it. Oh, yeah, IEF. I'm sorry. I started out with the small caps, showing you the relationship. Go back to my 60-minute chart here. And this is it. So there's that. Again, it's just you have to squint to see it, but we're popping a little into that green zone, a pop that will most likely get faded. Why do I say that? Because I wish and will it down back into the yellow zone. No, see negative divergence just like we had back here, overbought conditions, overbought, negative divergence on the 60-minute chart, and there's your divergence line. And that will most likely send us back there. Again, it's just marginally above when you zoom out. And more importantly, I like to look at the futures too. And this is ZN, it's my 6-month chart. This is the comparable yellow zone right here. Remember, we had that brief period back into the green zone recently. It ended with a divergent high and a rally into resistance. I highlighted that as resistance on IEF, the 10-year Treasury bond ETF. And so this right here is the yellow zone. So we're still in it on futures. And that's my preferred trading proxy too. Futures, but so I'll watch them both, and I just wanted to point that out. That's why I'm giving the that dip back in, that ever so slightly peak back into the green zone today, taken with a grain of salt. If we didn't have these divergences, I'd say it might have a chance to run, and of course anything's possible, but I speak in probabilities, not possibility, and the most probable scenario is that these divergences, just like these divergences here, and these positive divergences here, will play out, and positive divergence rally, negative divergence drop, et cetera, et cetera. Okay, so you're up to date on treasuries. Watch that. IEF should, and ZN should reverse soon, especially around this 111.020-ish level right there on the 10-year Treasury bond futures, and about roughly where we are on IEF. And if you recall, recently I put up some zones on USO, the crude ETN right there. Same thing, yellow zone, which starts to, obviously the market has been taking note. You've seen the NASDAQ 100's gone nowhere now for weeks, if not months, over a month. And that's because crude prices continue to tick up. They're in that yellow zone. We kissed the top of it recently. And if we break into the orange zone, same thing. That's where the market will start to really take note. And red zones where the stock market, I believe, will freak out. So I just want to point out, we're still in there. Nothing much to update. Got a little overbought, so pullback's okay. But you can see they keep, the pullbacks have been pretty contained so far in crude oil. And remember, not a lot of you are buying crude by the barrel or anything else, but this is the one. And it is also in the CPI is gasoline, UGA. Same thing. You're seeing gas prices obviously going up with crude, and it's taken out this 69 level by quite a bit. I started highlighting it back here, pretty much saying this was my yellow zone. This is more of an orange zone here. Either way, it's showing you the gas prices are near multi-year highs, and that's no bueno for, doesn't help Powell. Powell, I keep referring to him as the scorpion from the Frog and the Scorpion. Aesop's fables. And that scorpion, remember that, swam across, needed to ride across the river and jumped on the frog's back. Frog said, sure, but you're going to sting me. He said, why would I sting you? If we do that, we're not going to get over there. And halfway through the river, the scorpion stung the frog. And as they're both drowning and heading to their deaths, he said, why'd you do that? And he said, no, it's my nature. So that's Powell's thing. That's why I call him Scorpion. It's in his nature to be easy. He's been trying so hard to get back into easy mode. But these, stubborn, sticky inflation readings have been handcuffing him so far, and that's why you've seen the trajectory change quite a bit. I'll give the market full credit for kind of shrugging off the changes in the dot plot recently, but again, the technicals are the technicals, so we'll see. And more importantly, these are things to watch. A lot of people just wait for the CPI numbers to come out. Inflation numbers you can watch in real time here, day to day, tick by tick. Watch this trend. If you start to see this trend break down and crude and gasoline start doing this, and it's not from the stock market or the economy rolling over real hard and demand destruction, because that's a possibility. Remember, I talk about quite often my zones on treasuries, and I have a little caveat, if you will, that this right here, move up here, should be net bullish for the stock market. The only time it's not if it's a flight to safety. Now, again, I said earlier in the video, I kind of alluded to looking at the distribution, what I see, the market leading, the MAG 7s that are still in the MAG 7 group or the MAG 5, almost all of those are down today. That shows institutional selling. What's going up are the ones that are beat down, short covering, bargain hunters. And so I'm attributing this quite possibly, and again, one day does make a trend, to a flight to safety. Institutions may be moving some money in there. But again, a flattish day. I don't want to read too much. I just wanted to get an update out to you and show you the levels I'm watching. Okay, so I did an update on the semis for you. And remember, the semis are really the canary in the coal mine for the tech sector. And when you look at, the semiconductor sector, I like to say the canary in the coal mine for the sector itself are the chip equipment makers. And so here's Applied Materials. I had a different board there. Really starting to diverge here. You've got a trend line. The bottom line is you have two levels. I'm going to color them up yellow because they're very important if you want to follow this. And why this one? Because this is one of the biggest chip equipment makers. So when you see the semiconductor sector roll over, a lot of times these are the first ones because the order flows dry up. They make the equipment that makes the chips. And so when they start seeing a reversal or slowdown in orders, that's usually foreshadowing a turn. So we'll watch this. So trend line right there, very nice, clean uptrend line, divergent high, 165, 196.45, really good price support. And then KLAC is another big one too. And you can see just a beautiful trend line, pretty much a double top high with the divergence continuing to steepen here on this daily chart. So I'm going to tighten that trend line up, make it nice and clean, color it up yellow. And I think I already have price alerts set, but if not, I'm going to make sure. And again, just things that I'm watching. There's your horizontal level. This is kind of like the NASDAQ here, right? When you look at this stalling out, going sideways for the last month or so, bulls need to see this, bears want to see that, and that's that. In summary, the majority of stocks and sectors are still above the key uptrend lines that I have. The most important of the top sectors in the S&P 500. Tech has broken down both my primary yellow trend line. Remember, we had what I called the NVIDIA pre-earnings whipsaw for the NVIDIA, and then the Fed here. So it's been kind of noisy, meaning a lot of grinding, and that's what happens when you're in a sideways range. But we're below both my primary and benefit of the doubt trend line in the tech sector, and those bearish engulfing candles are still very much intact right now. So we just need to see which way this trading range is resolved, and nothing's changed. My yellow line is still 204.21, call it 204, and need to see that go to have a high degree of confidence to go aggressively short for swing and trend traders. The next one is XLV, healthcare sector, still above, not only above, but I've been highlighting this level since back here. We keep finding support on it, 144.55, my yellow level, but we are below the trend lines, both the benefit of the doubt, meaning the secondary, and the primary trend line. But like everything else, it's going sideways. So we'll see. And this is why, I'm not going to do 5 updates a day on a market that's going sideways. I told you the best thing to do right now. Swing traders are making nothing. You can't swing trade the market or a sector that's going sideways. You can actively trade it. You can trade within the range there. Use 5, 15-minute charts, 5-minute charts. Show you look for support, resistance levels, short-term trend lines, divergences, things like that. But this is that. I'm now on a 15-minute chart. There's that range right there, and that's the only way to make money right now in the market or in some of these leading sectors. But bigger picture, again, that is not for everybody. I know that from doing this for a long time. A lot of folks don't have the time or skill sets to actively trade, but there it is, 144.55. I still have alerts set on all those. Those alerts have not triggered. So if and when they do, then that's when we start to get, or I do aggressively short for swing and trend positions. XLF, also divergent high and bearish engulfing candle. And if I wanted to, which I'll do right now for fun, just put a BOD, benefit of the doubt trend line. Remember, the yellow trend line was my primary trend line, but we had the NVIDIA and then the FOMC noise. This is the FOMC noise, pre-FOMC, post, but we're back below. We faded the rally right away, put in a bearish engulfing candle on the financials immediately following the Fed announcement. That was the Fed pop. There's the fade, bearish engulfing candle, divergent high, and we're below the primary trend line. So this is now, if you want to do a secondary benefit of the doubt trend line, it comes off the same level back in the October lows, and you have 1, 2, 3, 4 additional reactions right there. But again, my yellow level, the important one is 40.53 to kind of give you that aggressive all-in short moment. XLY below trend. So that's the story. Everything's kind of broken these trend lines, back tested, but bigger picture is moving sideways. And you can see it again in these momentum indicators. Momentum is just stalling. So the market's not going down in the last few weeks or last month or so, but it's not going up either. It's just kind of moving around sideways. Somebody asked about UNG. UNG, again, split crazy on the daily, but I can go to 60 for you. So most recently we had a trade here. The futures gave us a breakout right here. We hit T1, we were gapped. So that was officially, if you're trading, and I always say this, and somebody made a comment, but it's so false. I talk all the time of the downside of trading ETNs and ETFs, especially those that track volatile commodities, especially this one, because it has to roll the futures. And there's expenses and slippage and all that other stuff. Personally, I like the futures for many reasons. So yeah, but I know a lot don't have it, so I have to cover this one. And the charts do work well on UNG, and even more so. Somebody made a comment about wheat. Wheat does a pretty good job, as good as any, WEAT, tracking wheat futures. I trade ZW wheat futures, but I do have longer term accounts that I don't have to do futures in, and Iris and stuff, and those I'll buy wheat. So there's no problem with that one, in my opinion. This one is notorious. And of course, the VIX ETNs are the worst. You're guaranteed to lose money if you hold them for a long enough, especially against trend. But here's what I wanted to show you. So this was our, previous trade. We hit the first target, hit the second target, at which point we had negative divergence. That played out. At that time, I said, look, if you didn't book profits there, even if you did, you could buy back in at the trend line. We hit it on the futures. You don't see it here, and that's another thing I prefer on trading the futures. I'll get to in a second. You have a lot more candles. You're trading around the clock, so you can see trend lines forming. They're more clear. You have a lot of opportunities. Somewhat, for some reason, especially in natural gas, you have the opportunities outside the regular trading hours, breakouts, and tags of resistance, targets, and all that. And so by the time, if you're trading UNG and you wait till 9:30, it's open, boom, you may have missed a reversal off resistance in the futures that happened at 7:30 that morning, or sometime during the night. Okay, so that was it. We made 20% there, I think it was, got out, and then I said we had a trend line forming on both the futures and UNG, the CTN. And I said that would be an objective stop below it. So that's when it stopped out. We took out that trend line. And then we had support here recently. We popped below that. But now here's what we have. So that was then. This is now. We have this big divergence building. We've been, we had divergence at this low. That was one reason we went long there. It was a divergent low. It was a beautiful trend line. It was a breakout. It worked good 20% hit and run. We're back there now. And so the divergence we had here back in mid to late February is the same divergence, even larger. It started here. Here's your divergence line right there, even bigger. I don't have it queued. Oh, let me queue it up for you. Give me 1 second. I'll pause the video and queue up another chart. Okay, and here's that chart. This is, let me change the tool color here. This is my weekly chart of natural gas. I'm going back to 2009. So this is kind of bigger picture. You can see if you look on all these lines here, these blue lines here are your divergent lines. There's an uptrend line, but these are divergent lines. Divergent lows, highs, overbought readings. You can see all the little annotations. This is, here's your 70 level. Anything there is overbought above that. And so what you have now is the biggest, well, two things. And again, I covered this a couple weeks back when we went long last time. We're at multi-year lows. This is the lowest we ever got in decades plus in natural gas. So natural gas, remember, isn't going to go to zero. There's never going to be a bankruptcy filing. There's never going to be a priced out of the market by a competitor, regulatory change. This is something that's around. It's still very much in use, and so basically it's at the bottom end of its range. Now, as I just talked on, UNG over time, you get that, it's not the best vehicle to be in, and there's really no alternative that I'm aware of. I think that's probably the most liquid exchange traded product. And, you can roll futures if that's your thing. But I like to strategically hit and run in natural gas. But I will say, again, we're at this long-term support down around this 150 level. We're coming off that, by the way. We're still above it here on this particular chart. This is stockcharts.com. And big divergent low. Last time we had a divergent low was right there. And that gas went from $1.50 to $10. Not saying it's going to do it again, but, history doesn't repeat, but it often rhymes. There was a divergent low. There was a divergent low. There was a divergent low. And you get the picture. So all the better when you have divergence at support is what I'm trying to say, and at the low end of the range. So natural gas could grind around for a while. Sometimes it gets down there and grinds around for months. Sometimes it does it, puts in another marginally low, but sooner than later with these divergences, it usually takes off. Where to? Right here. This is where based on these divergent minimum, that's I think a conservative target. Be a triple on your money, right? No, not a triple, but over a double. We're at 150 to 3 right there is a double, 100% return. So this is where I think it's going. So, but again, you got to sharpen your pencil and get in. Let me show you nat gas future. Okay, NG, natural gas futures. Change your color here. You've got a primary downtrend line right there, secondary minor downtrend line right there, which to pop. There's that equal low right here on the futures. This is the May contract, so we're back to where we were in February. Last time we went long there, and that was that 20% pop we did with the divergence. There was the uptrend line. Remember I was showing you back then, and I just showed you on UNG. Said this is the uptrend line that if you go, you might want to consider a stop below there, and that's what it did. It took it out. Gave us a downtrend, a little divergent low there, a little pop, tradable pop, but now you have even bigger divergence here on this. And this is a 3-month hourly chart. So you're at support with positive divergence. In that case, you can make a case to go long here. It's in a downtrend. You may want to just take a starter position and then add to if and when these levels go. This is pretty big, I think, right here, price-wise. About 177 right there. It's pretty good price support, and I think, and plus it'll take out this trend line as well. That'll probably be the catalyst to pop up there. All the better if that trend line goes, and then this would be your next target up here, about 190 or so, and then I would most likely add additional targets to this. So there's your setup there. And if it starts to get some traction, I'll do more updates, or if I get requests for it, I'll do more updates as well. There's going to be a couple stops along the way. I didn't fully mark this chart up yet. And there it is. So targets 191, roughly 190, almost 198, and 212 intermediate term, near term targets. Okay, why not? Just bought me a little starter position. Pause the video. I was considered early today, and I figured I'm going to cut out after this. I got to do a few things today. What else do I have for you? Let me just check my notes. Oh yeah, here's an update on wheat. Covered this the other day. Someone had asked about it, and I concur. It looks good. Setting up. This is a weekly chart, by the way, of wheat continuous contracts. This is an end-of-day chart, so it reflects as through last night's closing prices. I covered it recently. I gave you that little dotted line there that said it would be great if we could come down to this long-term secular bull market, or secular uptrend line, I should say. We've had great buys off that level before, highlighted in the past. May or may not get there. And you've got some pretty big divergences building. And again, whether it gets or not, you want to see for a long-term trend, buy signal, swings, trade signal, investment, whatever you want to call it. Obviously, a break of that trend line will help. Let me go to WEAT. This is it on the weekly chart. You can see that same downtrend line. Let me tighten it up here, nice and tight. This is, again, a weekly chart, so every candlestick is 1 week of trading. There's your primary downtrend line right there, and we're right up against it right now. So that's why we may or may not get down, have another thrust. If we do, we're coming back to multi-year support. This has been the bottom in wheat right here for a long time. We're still in an inflationary environment. It's not hyperinflationary as it was before. We're leveling off, but there's still inflation. And so commodities, for that reason, and really the charts. If the charts didn't say it, but again, there's a positive divergence right there. That's the weekly chart. Weekly target's about $6. I might have to sharpen my pencil and update these. I'm going to pull that line down there and tell you right now about 667, 750, and then we'll go from there. We'll see if it breaks out. You want to hone your entry down, you can go to the daily chart, which I just did. Right there, downtrend line, which we're pushing up against. And again, I just covered this the other day. R1 is resistance. All the better if it can pop that. So it's similar to what we can see on the futures. Yeah, I guess that's it. Not a lot of other things. There's some things I'm starting to watch. I'm not actually. I'll tell you. I'm not going to get into it now because I'm going to do another video. If you recall, last year we nailed the shorts on the restaurant sector. So PEJ is a restaurant sector. No, that's the leisure and entertainment. We did this one too. I did a video and I covered them both. The restaurant stocks fall in this kind of a subcategory, but this one has also, DoorDash is in here, but then you have leisure stocks like Royal Caribbean and others. Look at that beautiful wedge. And this is where we nailed it last time, somewhere in here. Milk that short trade down there. And then it's EATZ. It's a very thinly traded one, but I use this to track the restaurant sector as a whole. And there's where we shorted off that divergent high or that trend line break and gamed that last year, and that's coming up again. So this one's on my radar, and I will do a video and cover all these. This is where this one was one of my favorites. Beautiful place stop. They never got our stop, broke down there, hit our first and second target. That was McDonald's, and it's just come full circle. I never made that potential T3 a final one. We got out at T2 and come full circle, went up. And divergent high, it's an almost identical chart as back then. So we got that before. This one's already started to roll over. Again, McDonald's one of the bigger ones, and I'll cover them in another video, but there's some that stand out. Some look better than others here, and so I'll give you some individual trade ideas. I will say this. I know when I do these videos, some of you probably want a lot more long trade ideas. I'm just not comfortable. I don't see a lot of equity sectors that I'm comfortable with. I'd rather just sit and wait and pass on those based on the charts, the technicals, and everything else. This is where everything is based on risk and reward. So, along with the stock market, I see the risk of a blow off top is very small. It's always possible. So like I've been saying repeatedly, if you took the short last week on the break, a short at the top of the range, set your stop somewhat above. Somewhat is going to be relative to your target. If you're swinging down to the bottom of the zone, it's only a 3.5% drop from where we shorted the other day. So you'd need a tighter stop of, 1% or so, a little over 1%, wouldn't be much. But I also said, and I maintain that if we get down there, we'll probably break it because it'll be a complete fade of the FOMC pop. And based on the divergences, everything else. So that would be like I said, the odds go up even if we hit that near-term swing target at the bottom of the range, the odds are going to go up considerably that there's going to be a lot more behind that ultimately, whether or not we get one more reaction or a couple more reactions off the bottom, it'll probably give way. So, and then that opens up, remember, if I say remember because I do these videos every day, but there's a lot I need to update. The targets I gave you, if and when my 433, which is the same, this is that same range we're trading right now on the 15-minute chart. This is that box I have there. We're shorted on Thursday. That's where the initial swing target is right there. But then that's also that key 433 level. So that's why if and when that goes, then that opens the door to these swing targets and a move back down to the 200-day moving averages, which I think is very, very likely to happen this year. And we're already at the tail end of the first quarter. So I think in Q2, there's your window if you want a window, probably 3 months. But again, because I say this all the time, you don't get the sell signals, you don't have that doesn't happen. This is where I'd say a high probability of that being hit in Q2. The odds are going to go up substantially. I'd put favorable odds on it right now, but I put very high odds if and when 433 goes, that we're going to go down, not just to the first target, but all the way down here to at least T4. 200 days are coming in right now, roughly. They move up every day. Now, if we start to roll down, but we'll probably, like I said, that's my current preferred target at this very moment, if and when 433 goes, or even right now. Like I said, the odds are going to go higher. In other words, what does that mean? It means just that, but it means that's where I'll go to full position short and swing that down if that goes, and may not even game. Depends how I'll tell you right now. I'll probably game a reaction off T2, not off T1. I think I already shared that with you, and maybe that means reverse, cover short, game a bounce, and then do the same thing on T4. All right, guys, I'm gonna wrap it up here. Got to get out and run some errands, and yeah, I don't see today's a kind of a flat day, so nothing more than what I shared with you today that stands out to me. And if you guys see anything that does stand out to you, or you want an opinion on something else, go ahead, post it in the comment section. I'll try to get to it as soon as possible. This has been Randy Finney with Right Side of the Chart. Have a great day.